Thanks for your
Hey
patience.
guys, no worries. Okay. Hey guys, welcome back to Seller Sessions, 4 p.m. UK time on a Wednesday afternoon. Chris is with me today. Chris, the first time on the show. Do you want to give a bit of an introduction to who you are? And a bit
That'd be great. Well, thank you, Danny. Thank you for your patience, man. I was begging somebody, I got to get off the Zoom. And finally I just ended it. So appreciate that, man. Yeah. Thank you for having me on the show. I am a managing partner at Global Wired Advisors. We're a lower middle market investment bank, really focused on consumer products, specifically with heavy e-commerce concentration. So not just necessarily an Amazon FBA business and 100% concentration. We've got we really do focus kind of across the board when it comes to consumer products. And we offer several different products in our investment bank, but here today, what we're chatting about is selling your business. It's the sell side engagement side of our investment bank, where we put together the marketing materials, prepare your deal for market, and then put you in front of lots and lots and lots of different potential buyers to buy the company.
Yeah. So can we I think probably best to break it down in layman's terms, because obviously when Amazon sellers know their businesses inside out, but when it's their first time of selling their businesses, it's a blank slate. Most of them are absolutely clueless in a nice way. When you do something for the first time, you literally are going to be, right?
Yeah, that's right.
So we've got the advent of aggregators being in the space, which has been great. It's made life-changing money for a lot of people. They're hoovering companies up on a monthly basis. What makes you different from what the aggregators are doing? I think we should get that, because people think of as investment banker, they're just assuming people walking around in suits, right?
Lots of suits, and they want to know, they want to ask a lot of questions about their stock portfolio and which different
exactly. But you're actually out here, whilst not an aggregator, sorry, you're out here buying businesses. So let's kind of distinguish the playing field. What's different about the two?
Yeah, so an aggregator is really it's a private investment vehicle. It's a fund, right? They've raised money for the sole purpose to go and acquire lots and lots of businesses. Mm-hmm. And in particular for this sector, it's typically businesses that have at least 70 to 80% of Amazon revenue, Amazon-based revenue. Yeah. We are not doing that. So we have not raised a fund to buy. We are taking businesses to market to sell their company to potentially an aggregator. But for us, the way that we run our process and the type of businesses that we work with, we're actually putting them in front of, a lot more than just the aggregator model. We're putting them in front of true funded sponsors, which private equity funds, and also family offices. With the amount of wealth that's been generated over the past 5 to 6 years, family offices have popped up. And really, that's just a cute way to say it's a family. They've got lots of money. They need to deploy that money somewhere. And so they deploy it into investments. And sometimes you've got multiple family offices, meaning you've got lots of very rich families that put a lot of money into one pool to go invest. Well, they're now looking at e-com assets. And then you've also got what we call corporate strategic. So Danny, let's just say you own a stroller company, right? And it's really successful and it's starting to gain some market share and it's out there and getting lots of attention from other stroller companies. Well, a corporate strategic would be us taking your company, your deal to that corporate strategic to say, hey, by the way, this guy, based on all the market share data that we've been able to analyze, our client has taken 15% market share and is eating at your ankles. You want to purchase this company. And so, we have a really wide range pool of different buyers. We don't just focus on taking an Amazon business only to an aggregator.
Yeah. All right. So what kind of defines these guys? Because this is really like, I speak to a lot of the aggregators in the space. They sponsor our events, et cetera, and a lot of sellers have sold to aggregators. But with what you're doing, did you guys see what was happening with the aggregators and decided we want a piece of the action? Is that literally what happened? Is that they kind of set some sort of trend in the market, or was it leveraged because of the nature of COVID and how commerce grew? Then suddenly everyone is switching their mindsets of where they want to invest their money.
Well, I mean, look, we started with the thesis that as a business owner like yourself, An entrepreneur deserved better when it came time to sell their business, right? And so instead of choosing a process that we believe was suboptimal, and the process that currently existed and to this day still exists is what we would consider a traditional business broker model, right? Where come to me, I'll list your business, I'll send it out to a large email list. Whoever bites, let's pursue those bites. But then you're going to get on the phone as a seller, and you're going to be the one really selling your own deal, right? And so we saw that and said, look, man, my partners all worked in the institutional investment banks, and there's a M&A process that is followed in both what we call the middle market for larger companies and the institutional world for very large companies. And we said, hey, if we take this same process, right, very detailed, very thorough, you get to know the company, you put together a very, very, very strong marketing materials about the business, you put together really good forward projections, you outline what the forward opportunity is for the business, and you put it in front of different types of buyers versus an email list, we think it's going to have a different outcome. And we were right. And so that was our thesis coming in. Now, this was pre all these aggregator funds. So at the time, we were taking businesses, which we still do, and presenting them to private equity funds and family offices and other corporate strategics. Aggregators is really, they've popped up over the past 14 months and they continue to barrel down like crazy. There's just so much fast money that's coming into the space right now. You look at Perch, they just raised $775 million. And that's real institutional money. It came from SoftBank's Vision Fund too, right? Spark also had a little bit of investment in that round, but largest Series A round ever raised for consumer products. It's unbelievable. So, this is a lot of venture. It's a lot of fast money that's coming in the space right now. And they are, buying up very specific types of businesses, though. There are a lot of other businesses outside of just Amazon-focused businesses, right?
Of course, yeah.
And so, for us, we still run a process where we're not just going to take a business directly to an aggregator, right? We're going to include aggregators as part of our buyer list that we create for a particular client of ours. But yeah, we're not just going to take them directly there. We believe that, a business owner who takes the process of selling their business seriously wants to hire strong representation to put them in all types of buyers' hands, not just one particular class of buyer, right?
Yeah. How did we get through the knowledge gap doing it your way? So, for instance, let's say the top 10 to 15 aggregators, very knowledgeable on Amazon. What's to say when you're putting an assortment of people together that when someone, I know you shouldn't get attached to your brand, but no one wants to see sell their baby if they treat it like that and they put blood, sweat and tears into their brand to give it to someone who's absolutely fucking clueless. So how do you mitigate that kind of thing so they don't run the fucking thing into the ground? Because the upside of the aggregators is that they're very knowledgeable. They share a lot of knowledge in the space as well, whether you agree with it or not. But there are key players out there who know the model inside out really well that I've met, and on a technical chops that they've got. I know some very sharp people that either are some of the heads of these firms, and this is on a technical market level, or they're working on the team. Very, very bright people. But there's also people that have been raising funds in the space who has no idea to do a transfer from a Seller Central account after purchase. You know, and that's the danger. Is like, for me, is like I'm on the side of the Amazon seller. Like what I'm trying to represent in these conversations and these very open conversation, what is the best for the seller? Because that's what I care about, not what is best for everyone else. And that's one of the danger things I think you find is that when loads of money is being raised and people are good at raising money, but they're not good at the intricacies of taking over a large business. Let's say you're spending a shit ton of money on PPC. Right. Yeah. I know people, and we've had it where they literally unplug from us and then burn a shit ton of money. They're not running parallel campaigns. They're not doing split testing and moving the campaigns over and creating improvement in impression share over time to reduce their costs. They're just going wham, bam, thank you, ma'am. And so they've calculated that in.
Yeah.
But they're spending a shit ton of cash on the handover from the purchase, which I think is kind of bizarre, even though they are very sharp in what they do. So there's a lot of integral things. And then how does your guys know to spot for black hat? So how do they know how to reverse engineer? Does that make sense? I'm throwing a lot of questions at you.
Yeah, it's a lot. It's great.
But I know on our pre-call, like yesterday, you've been doing Amazon and since 2003. So you've been in the game long. Yeah. Is it 2003?
Yeah, well, Vendor Central, about 2004 or 5.
But that means you've been in the game longer than most of the people that we know in this space. I only came into the game 2015, so it's like 6 years ago. So you've got a good decade on and some change on me. So
I mean, look, it's how do you? So there's a lot there, and I'll try and start with kind of trusting who to sell to. Well, look. Aggregators are focused on Amazon-based businesses. That's what they're focused on. But, the types of clients that we work with, they usually have EBITDAs between, or net profit between, say, $1.5 to $10 million, right? These are top quartile category leaders. But they also have good staying power on Amazon, and they also have really the genesis of brand, right? Like real staying power and brand. Well, look, there's only so much more you're able to do on Amazon when it comes to a specific brand, a specific category. And as well as I do, there is, and I sold in all of them in my career, there are a ton of different sales channels, right? When I worked for a middle market business, it was, close to $500 million. Amazon was but one channel. I just met with a guy who's still an executive there for lunch a couple of weeks ago. Amazon is probably about 60 million of their business and growing. But when they talk about their 3-year business plans, or they just talk about their business plans in terms of, in the boardroom, Amazon is but one sales channel, right? And so, there's more to it than just Amazon. It's about trusting that particular buyer to grow the company and where is it going. And I'll tell you, if you want to look and pick on the aggregator class, I'd say a majority of them actually don't know what they're doing from an operational perspective.
Really? Okay.
Yes.
I would argue the top 10 know exactly what they're doing on an operation level, but there's more than 10.
Out of
100. Yeah, I don't know the rest. I can't judge.
90% don't know, and I would absolutely 120% agree with you. I think there are 10% that do, but what's interesting is they're both trying to be great at M&A, and they're trying to really be good at operations. And unfortunately, you either have one that's really good at operations and not so great at M&A, right? Or you've got one that's really good at M&A and just okay with operations and still learning. You got to also, too, I think you'll appreciate this fast money is fast. So they're building teams quickly. And as you build, I mean, look, Thras went from 0 to 800 employees in a matter of 16 months. That's amazing.
But they're the fastest growing profitable startup of all time, apparently. That's
it is my understanding. Lots of great. But at the same time, look, I've been in businesses before where you've seen that type of fast growth, and I've observed businesses in the past where they went through that type of fast growth, and you talk to the employees, and it's a bit like a helter skelter. So you're going to have a little breakdown as you're growing, right? But nonetheless, you're right. 10%, I'd say probably good at they have what we call operational alpha, meaning that they're really good at operations and they continue to get better and they're hiring the right people. But at the same time, it's like, okay, well, that's obviously one class of buyer that you can take your business to. I think the education that we're constantly trying to get in front of the seller community is that there's more out there than just that class of buyer. It's fast. They close quickly, which, by the way, it's not 30 days. You've probably heard some people, but their averages are going up because they're taking more time to do due diligence. Why? Because they've done lots of deals, and they know that they've got to take a little bit more time on the due diligence period, right? Because they've realized on the other side of closing too fast presents itself with some headaches. Traditional private equity firms, when they close a business, they always give it 60 days, sometimes 75. There's a reason for that. They just know that due diligence takes a while. It takes a minute, So we're always trying to educate sellers that, Danny, there's more than just this class, especially. And I'm really talking.
I agree with you, but I think the problem that you got in, let's call it, we're in this Amazon community, which is our own little bubble. And I agree with you, because I'll go and speak in the UK at the larger commerce events. So I'm known as like that Amazon guy at the biggest commerce events. And when you get there, some of these events is like the Amazon, or the marketplace rooms that they call it, is there a whole 200 or 300 people.
Yep.
But you're never going to get on the main stage unless you're talking main SEO to 3,000 or 4,000 people, because Amazon is still treated very much niche. So I agree with that. The point I'm trying to get across is that if you're in this space, like you're coming in now, I think you'll find there's not a huge chunk of these people, even 7-figure sellers. We've got dozens at the agency, because we only work with 7 figures and above, right? Clients. But I would argue that most of them won't have a 35% footprint off of Amazon. Most of them.
Right. No, it's true.
And so your educational path, I totally get it, because the world is bigger out there. But the mindset of a lot of sellers is, why would I go off Amazon when I can launch another product? Because it's like least path of resistance. If you've got your launch strategy down, it's very easy to just keep doubling down. Does that make sense? But I agree with you that it's important to have growth, because we know that at 25 to 35%, that is going to make a better impact on your multiple than it would be having 10% off Amazon.
And I would say don't. That's not really the point. The point isn't about your revenue splits. The point here is that even if you're a 100% Amazon-based business, there's more than just the aggregator class.
Oh, of course. And
that's the point, is in terms of the buyers that are out there. In fact, through COVID and really the paradigm shift that we've gone through, everyone notates the McKinsey study, but that's one of many, many, many studies that are out there showing the impact of COVID and e-commerce and now the behavior stickiness when it comes to especially baby boomers who have lots of discretionary income, my parents, your parents, who are now actually buying things online, some for the first time. 7 million just in the United States, new online buyers. You've got lots of capital. And by the way, all this PR that's coming out about all these raises with aggregators, don't think that PE and corporate strategics and private and don't think, and family offices, they're just sitting on the sidelines going, well, that's just for them. No. They're taking notice, and now they're wanting to get involved. They're wanting to purchase, and also too, they want to lever their portfolios inside of e-commerce now. So if you're all Amazon, that's great. The good news, lots of smart capital is starting to look past the Amazon platform risk that they couldn't get over 2 years ago.
Okay, let me ask you a question here, and then because you just brought up a good point. Do you think is that while a lot of people are buying Amazon-focused businesses, there's a good reason behind it? Why? Breaking into retail. Let's say you've got a fantastic team on the back end. You're buying Amazon business, only Amazon businesses that are focused on Amazon. So they've not sold anywhere else. So the opportunity there is there's a valuation there beyond the initial sale, because they've got great teams that are working for retail. Could that play a role as well for the benefits?
Yeah, of course, because when you're talking about forward opportunity, and then you've got real objective data to back that up, and you say things like that, when you say, hey, look, here's the only reason we had a client that $25 million Amazon business, about $6.5 million worth of EBITDA, maybe a little bit more on the top line. They got into Home Depot. They got into Menards, which is another kind of larger kind of general store here in the United States, mainly up in the north. They were talking to True Value. They were talking to Ace Hardware. They couldn't do it because all of their focus and energy had to go into Amazon, because Amazon, it demanded all of their effort, all of their resource, right? Yeah. However, that particular transaction got an unbelievable trade because they already had the tenants of Home Depot, which they had real sales volume. We were able to project out, if they got into stores, this is what it would look like. and it passed. It was very defendable. And they also had the team to back it up. And so when we took that to market, you had a tremendous amount of interest in that business because it was very attractive based on the tenets you just described. Now, let me compare that. I'll compare that to a business that we call it has product ADD, not even brand ADD, product ADD. And I think it's a little bit of a cancer, I would say, on some businesses where you look into Seller Central and you've got 5 different brands, all different products, but maybe the cash flow is really rich. That you're probably going to be purchased by an aggregator, and even going through an aggregator process, you're going to struggle and you're not going to get the deal all of your friends are telling you they're getting. Right. So, I mean, look, you still have to have, in order to kind of pierce the veil of just this aggregator class, you've got to have tenets of being, a really good, solid business, right? Yeah. And so, yeah, I think that's where, I want to be clear. You can stay on. Before all of the aggregators came along and before COVID happened, I advocated for people to go off Amazon, find a way to own the data. I still advocate for that if there's a strategy to do so, because owning the data is really important, right? Yeah. But now where we are today, the world's changed, right? E-commerce is Amazon platform risk is not nearly as high as it was a few years back. So,
well, it's more difficult. There's more barriers to entries now with certification and access to getting reviews, and we have to be a lot smarter nowadays compared 100%. To 2015. So yeah, I think the playing field is far from level. It's gone up. You've had to raise your game, and only the strong survive, especially when you've got to look at that piece of shit that is Seller Central, which has got an interface only a mother can love.
It's so true. And look, I would tell any seller and anybody buying in Amazon, anybody buying business on the buy side would be lying to you if you ask them the question, do you think the way I can get a fully optimized exit is by either going direct to you, or should I go through a process, a really good process? I think that's a way to truly kind of checkmate. I think it's a way to checkmate what's currently happening in the.
Okay, let's compare the average process. A bird's eye view. You looking in. Let's say the process of an aggregator, how you visually see it, because they're all going to be variables of the similar thing, right? Mm-hmm. Yeah. And then your process, and let's have a quick comparison.
Yep. Yeah. So I would say, look, an aggregator is going, everybody's getting their inboxes are getting nailed right now, right? Everybody's inboxes are getting nailed, and really they're continuing to create differentiation. I think Thras has first mover advantage, hands down. I think a lot of people know who they are, and I think they know Thras and a couple others, and they don't know aggregator number 98, 99, and 100. I think 98, 99, and 100 is I don't know how they're going to survive. Yeah. Another little interesting tidbit, I think you and I spoke about this yesterday, but the spigot of new aggregators, the capital spigot, that has been turned off. It's done. Right. So we're not going to probably see, and we haven't heard, and we're probably not going to see a whole lot of new aggregators. You're probably going to see kind of going forward, the strong surviving. But they hit the inbox and they say, we want to, we've identified you as a great asset. We want to buy your business. We're well funded. We've got, we'll close in 30 days. We'll, et cetera, et cetera. So, seller replies back and they want to go ahead and take the next steps in terms of the process. They request a lot of different financial information, balance sheets, et cetera, but very minimal data. And then they really quickly put together a deal structure, and then they force you, exclusivity, or you have 30 day or 30, they're
under offer, aren't they? So this,
and you have a day to decide, like, this offer is only good for a day or 2 days. Right. Well, like, okay. This is if you take what's happening and you take that process, while that does happen in other industries and sectors where you've actually had private equity firms go after brands and say, we've identified you as a strategic purchase, we'd like to talk to you. That never happens. That's a completely new way of trying to buy a business. And by the way, they haven't done a whole lot of due diligence at all. Let's keep that in mind. The only thing they're trying to do is they need to just get you in. They need to say, accept my offer, get you in. Then when you're in, you're under exclusivity. They've got 30 days, 45 days to really determine if they want to buy your business. So they take you all the way down the path. They start to do the due diligence, and the offer that was offered in email now looks a lot different as you're getting closer to the close. Why? Because they have a chance to actually go through all the details and all of your data. And guess what? They're probably going to find some things they don't actually really like. They're probably going to find some things that they're going to use against you. And guess what? You have zero representation. You're fumbling around to try and find a lawyer, but you should never let a lawyer run your deal, and never, let a lawyer determine what your deal structure should look like, because that's not what they do. And so here you are going, oh crap, this looks a little bit different. Now, some guys don't care. They could give two shits. And thank goodness I can speak like this on this podcast. They to give two shits, right? They just go, I don't care. I can't believe I'm even getting a check. I'm not talking to those guys. The types of folks we're talking to are the guys that go, I can't believe you undervalued and hear me out, brand, not product. I can't believe you undervalued this product or this brand. And those are the guys who go, probably take a breath of fresh air and say, okay, look, I need to go through something way more sophisticated than what I just did. I need good representation, and I need to take this out to more than just this one guy that I spoke to. There's 100 of them. But outside of those 100, there's a lot of other potential buyers that you want to put your deal in front of. And so a typical aggregator process looks a lot like that. In some cases, I may have described them a little bit predatory in some ways, but I not all of them are like that. They're really lots of very lovely people. Some are not lovely people. You know this, you've met a lot of them. But there are a lot of lovely people who work for these companies, but that's how they go after directly to the seller. And we're here to say, the checkmate in all of this is you ask them, hey, do you think I could actually get a better deal through a process? And if they say no, they're lying to you. Flat out lying.
Interesting. Yeah, I mean, just to counter your point, I know that I won't name names because that's not what I'm about, but there's some of the bigger aggregators do close a lot of their deals, and they pride themselves on it in that process because it will end up leading to bad reputation otherwise. But there's some out there that leave people pissing in the wind, and their close rates are really poor. So I would say what you're saying there's definitely truth in it from my knowledge and understanding, which is minimal compared to what you guys do. But I also know there's guys out there who optimize in that path as well to close. It doesn't change the valuation or how they valued it, but I do know people that are very intent on that bit. So I just want to be clear. So
110%. And I would say there where none of us actually have a chance to look at the data, and at that point the seller can say whatever they want to say. I would say if you were to turn the lights on and expose everything, and you would compare someone who went through a process, because we have been able to do this. We have real data points of people who have come to us and handed us aggregator deals, and from all different types. We took them through a process. The disparity was the difference was massive. Yeah. I would say that they did it and they closed because the seller just said, I don't want to go through a process. That sounds too tiring. It sounds too long. I'm okay with what's being offered, even if I just got told X, but now I'm closing at Y. I'm staring at several $1 million. What's the difference?
So the mindset is, look, I'm at the moment, it's not that I'm broke or anything. I'm running, I'm talking about we as Amazon sellers. Your major expense is going to be your inventory, right? And especially with what's going on at the moment. So if you're a seller that doesn't have any money in the bank, but everything's within the business, and you had COVID last year and you're in travel, and I've had clients and friends who lost 90% overnight through COVID. When you look at that and the stress levels are taking that off the table, it's like in 30, 45, 60 days, I'll have legacy money. Why am I fucking around? Just do the deal. I might get squeezed on the point here and there, but I'm going to be a lot more safer to go again. I can take that historic brand that I've done all my learnings on, and then I can go the second time around. And do you know what? When I get fucked over by Seller Central, or I get suspended, I've got a shit ton of money in the bank, and I can have a smile and a Coke.
It's true. No, it's so true. And look, man, there's a ton of potential deals out there, right? Tons and tons and tons and tons. And I say potential deals, that's my language. There's a lot of different sellers, right? A lot of sellers. And so, I can tell you the amount of deals that we do per year is a very small fraction compared to the size of deals that are out there for aggregators to go and purchase. And we're also very strategic. We're not transactional. I've had several sellers that I've spoken to where I've just flat out said, look, based on what I see and on your business, I just told a guy this, it was not even a month ago. I had a great conversation, really great dude. I actually helped him kind of navigate his way through a couple of aggregator bids. He sent him over. He told me about his business. And I'm like, there isn't a broker, there isn't an M&A, there isn't an investment bank. There's no one that's probably going to do better than what you just got, because honestly, you're a commodity. And if you have bids, you need to hit the bid now, because I'm telling you, when this market matures a year from now, because everything's moving so damn fast, a year from now, you will not have a bid, because this whole fast money and I'll just buy cash flow, that shit's going away in about a year.
Hold that thought, because I want to expand on that, on what I call the bubble. Kirev says the biggest issue with acquirers and external management companies is the incompetence of the majority of the brand manager in these firms. Okay, so that's a blanket statement. Do you have any examples, without naming companies, just examples of experiences you had, to drop in to the comments, and then we can address that? And then let's talk the bubble. Let's talk a year from now, the tip out and stuff that you think that's going to go on, and the winners and the losers of this bubble race, if you want to call it that.
Yeah, look, man, gosh, we could talk about this for literal days, I feel like.
Let's do it.
I know. I'll try and break it down without trying to get too verbose, and genuinely, I'll try and stay in my lane. So I don't want to try and get into territory where I'm just making things up or doing wild speculation, but there's a lot of fast money out there, and I think that there's going to be some failure. And once you start to see some glitches in the matrix, as fast as the money came in, that fast money is going to go out, right? Because they're not going to be comfortable. Now, you've got SoftBank, who clearly got very comfortable with Perch. You've got, lots of money that was raised for Thras, lots of money that was raised for Heyday. You're starting to see other Series A's that are popping up. I think that's going to slow down. Right. I think you're not going to see nearly as much cash being raised. And I think you're in a little bit now. I mean, you start with phase one of no new aggregators, right? And then you go into so that's a, hey, let's wait and see. Let's see what happens. Yeah. You've got the good aggregators who are actually, kind of raising more cash. And I think now that's going to be a little bit of a wait and see. You've got an IPO that's probably coming from Thras, I would assume, in the next probably year. That'll be very interesting to observe and give us lots of data points. I just don't think the current model that these aggregators have adopted, I don't see it working for a lot of them long term. Right.
So again, there'll be a tip out. The top 3 to 10, would you say, are going to push through? We know that Thras is already in the lead, right? So 100%. They're dominated and innovated in this market. They're the guys with the target on their back. It always is. It doesn't matter if you're a big software brand, a football team, a baseball team. It doesn't matter. People
got a lot of these out there.
Yeah, exactly. And where does criticism normally come from? Below. Generally, that's the way it works.
It's true.
So whenever there's someone who's popular or a brand's popular, breakthrough, there's the nicety stage where everyone are nice about them, and then behind the scenes they're ripping to pieces. So I think what's happened is, like with anything, someone ends up with a bullseye in their back, but they are by far, I would say, the market leaders, Thras, in terms of what they're doing. And there's a lot of good people over there. But going back to your point,
I think, look,
this 18.
Yeah, here's another point I think you'd agree with. Look, brand cycle is becoming shorter.
Yeah.
And it's going to continue to get shorter and shorter. And so these guys need to just have an absolute long-term M&A machine.
Yeah.
They've got to keep buying and buying and buying and buying and buying, right? To keep up with the same reason why they bought the businesses, because of short brand cycles. That's it. So there's something there that could also create a breakdown, that could also create a potential bubble in the future. Now, I'm still internally, we're talking a lot about this, and we're still noodling on a lot of these points. And so I don't have anything fleshed out. I also don't have a damn crystal ball. So we just speculate like a lot of others do. I think when you just read the tea leaves and you also compare it to other industries and you see where most of this money is coming from, which is venture is all about canary in the coal mine. And so they're all about, hey, send it in.
It's about hits, isn't it? It doesn't matter how many well, it does matter how many losses, but out of the money that you've raised, you want to find a Twitter, you want to find a Facebook, you want to find, and that's the goal, isn't it? They know not everything's going to be a hit. So the investors spread their bets, and then something normally runs like a unicorn.
That's right. You know, one study that hasn't really been done is where is all the money truly coming from?
Yeah.
Right. And I think it would be an interesting research report to understand where all of the cash is flowing from and to kind of see all the different sources. And when you really boil it down, I think that will present some very interesting data points for how little resources or how small that pool really is, where it's coming from. I mean, I know of a couple of different venture shops that have invested in several of the aggregators. And, you know, it kind of feels a little bit, I'm dumbing this down, but it's like kind of going to the roulette table, man. You know, you take your chips, you place it on a few different numbers and different quads and maybe on 00 and then maybe on red. And, you know, we'll see what hits whenever the ball goes around. Now I'm dumbing that down, and that's a really, really loose analogy because there's just so much more to it than that. And a lot of data, of course, but, the other thing that's happening in every industry and sector, and I spoke about this in a couple different conferences, but you know, when you look at the geological eras, like when you go to the Grand Canyon, I'm not sure if you've ever been to the Grand Canyon or not.
No.
But you look at the different geological eras and those rock formations, and really you can see where if you look at kind of the aggregator and venture money that's here, it's just one sliver of the geological era. You know, typically what happens is, you know, venture will come into an industry, they'll come into a space. Private equity are more traditional, they're more conservative, and they hold back and let venture be the true canary in the coal mine. And once they've been able to make all those mistakes and there's lots of failure, you tend to see private equity then come in and start to invest in a particular space, but they're doing it from a lot more data points than they would with, say, the venture guys. Now, the venture guys, high risk, high reward. Private equity, that's when the space is beginning to mature. Well, what's interesting is, and this is why I keep talking about it, and I've spoken about it here on this live feed. What's really interesting is the reason why private equity also doesn't come in typically right away is a lot of the venture type businesses are not cash flow positive for a while, right? The difference, Danny, an Amazon business can be cash flow positive from day one. Well, that's interesting. That's different, right? And so that's why we're starting to see with the deals that we take out to market, we're starting to see a lot more interest in that private equity class, in the family office class. Because when you're presenting these businesses, you're not presenting pre-revenue companies. You're not presenting cash flow negative, or you're showing a burn rate in terms of the cash flow that needs to be in investment that needs to be invested inside of the business. You're actually showing cash flow positive companies and with real forward opportunity. And frankly speaking, lots of really strong opportunity on the business, you know? And so that's where I think, you know, you're going to start seeing more private equity come into the space. Right now, it's more or less on, at least from our perspective, on a deal level. I think you're going to start to see more conversation around smart capital wanting to invest in this space. But there's going to be some big events, I think, that will occur. I'm painting a large paintbrush here, but there's going to be some big events that are going to create some amazing data points for this whole industry. I think you're going to see some failure and you're going to see an IPO. And from those two things, I think it'll produce a lot of conversation. And
so where do you stand where the situation, what's your assessment of the market outside the top 5, 10, you know, Elevate Brands, Frasio, Perch, and a few of the other guys, right? Where do you see their placement come in terms of them raising money and buying businesses that are maybe not optimal, but they're under that pressure, aren't they, to close some deals? Because if they've raised the funds And then they're going back and they're going, well, who have you bought this month? Well, that didn't go. Then it's going to come down to multiples as well. And when we done an aggregator round table, and we had the Thrasio boys on and the guys from Elevate Brands as well. And they are saying that there's silly money in the market as well. People are paying over the odds for stuff, maybe from their perspective.
Yes, definitely.
The point I'm trying to get to is that I always say to all the sellers that we represent who look after the agency and stuff is like, take some fucking money off the table. Now's a good time to be an Amazon seller with what is going on whilst there's money here. Now, you're saying is that maybe there's a bit of short change and that you can go to all these different institutions that you lay out in front of people and give them money.
And even if you're just going to the aggregators, you should always go through a process. That's
of course, yeah. But my point is, do you think is a really good time is that while the money's out there, let's just say you don't, I can't say something because I'm under contract. But I wanted to present something I had to say to a client. I'm like, are you fucking mad? Just take the money. But I can't explain the reason why I said it because it was a ridiculous offer for what's sitting in front. Does that make sense? And I don't think any of the big guys would have touched it because it's not right. I'm trying to, because of contracts and stuff.
Yeah.
But with that in mind, I'm looking at it and the boys of Thrasio and Elevate Brands were like, look, if there's silly money, just take it in their perception of silly money. Yes. So the short part of this question, shall I ask you, should Amazon sellers be looking to flog their brands now just to put some money in the bank and going again because it's a good time?
No, not at all. I think if you think you have a commodity and you don't really are building a real brand, I would say, of course, 100% I would. But if you believe you're building something much bigger than just, I've got a widget, I have a garlic press that I've built $1 million of cash flow and 5 different aggregators are going to bid on it. Yeah, sure, do that. You know, that's that's always the most picked on product in the Amazon cottage community is the damn garlic press. But yeah, if you've got something like that, by all means sell it. But if you're building a brand, and that's mostly who we're working with is business owners who have built a brand, they've built a team, they're looking well beyond just the Amazon space, and they're trying to look at what the brand might be in 2, 3, 4, 5 years. They care about what they've built. They care about the product and the brand that they've been able to grow. I'd say no. And look, that's a little bit of a different mentality too than say the guy who's just really building cash flow. If you're building cash flow, man, gosh, and you can hit it. It's what I told the guy on the phone 2 months ago. I mean, we had a wonderful conversation, but I'm like, you don't really, this is your time to shine, man. Like if you don't sell now and you don't take this bid and you wait a year, I'm not sure you have a bid. Like I'm not sure you actually have something that anybody else other than, and so here's what's interesting, man. And I actually need to, I say this as a blanket statement. And so I'm going to caveat this as a blanket statement. But, one of the things that I think you should always ask anybody who's approached you, who wants to purchase your business. I was on the phone with a fairly decent sized private equity firm outside of Boston yesterday. And we were just having a good conversation about this space and how they just recently got into e-commerce and they're really looking to expand more deal flow into e-commerce. Truly a lower middle market private equity firm buying brands with $20 to $80 million worth of revenue. And they use the terms, here is what our investment thesis is. They said the words investment thesis. And then he clearly laid out to me, the brands they buy, what they do with them, and what it looks like long-term. I'm not sure, and please correct me if I'm wrong, and I may have heard it. I think Thras probably has a strong one potentially, and I think others do too. Some of the top guys do. But have you actually heard any of these funds that have been raised say to you, Danny, here's our investment thesis? Like when we started Global Wire Advisors, we had a thesis. Our thesis was this is a industry, e-commerce concentrated consumer product brands are underserved when it comes to selling their company. They're underserved when it comes to having real access to investment banking product. And so our thesis is they deserve better. We started the firm and everything I said in the beginning. And guess what? We've shown that, okay, our thesis is proving to be true, right? But we had a thesis. So I guess I'd throw it back to you, man, and say, have you heard? And if you have, what is the investment thesis? It usually informs you of the long-term play outside of, well, I'm just buying a bunch of businesses. I'm going to roll them all up. And then I'm going to, okay, well, that's an investment thesis. I'm going to sell them to another. I want to sell it to P&G. I want to sell it to Unilever. I want to sell it to a large holding. I want to sell it to Kellogg. I don't know, a large holdings company.
So I'll answer that question in two parts. I think I've had these conversations with people, but I don't remember the outcome of what I remember. People have mentioned they have a thesis, but I don't remember exactly what they said. And it'd be unfair for me to comment on that. Right. We've actually not remembered it. I think we're probably pissed at the time having a networking event and say our thesis is this and this is what we do and and that's why I probably can't remember it. So the answer to the question is an honest no, but I do recall that people have brought up, they have a thesis but not necessarily told me the full execution.
Yeah, we've heard it. We've heard it from some of the names that you've mentioned, some of the kind of the top guys who've raised lots of cash because they're out there. They have to have a thesis, otherwise, someone like a SoftBank.
Well, you've got to have a plan because no one's going to give you any fucking money, are they?
This isn't fucking charity, man. They're not just going to hand it out. Like, you have to have a strong thesis, and I believe that. But I think when you outside of the top guys that we've been talking about, just in this particular class. And again, when you talk to all the private equity funds that we speak to, it's the first thing you hear because they're very focused on what they want to invest in, right? They're not just out there going, I think we'll invest in X today, and they're really not agnostic, right? They're not just buying everything. So they have thesis. And I think outside of the top, as you waterfall into lots of the new guys that have come on the scene, I think, and the new funds that have kind of popped up, I think the investment thesis is either non-existent or so heavily diluted, you don't even really know if there is a thesis. I think it's just, I need to buy as much cash flow as possible. I need to build up that cash flow through my operations that I'm building out. And oh, by the way, my operations is better than their operations. And then what? I don't think they actually really know yet. I think they're trying to figure out their own end game as things almost in real time. So anyways, just a thought, just an observation.
Excellent. Well, look, we're coming up to the top of the hour. Let's round off here. So we kind of discussed your interpretation, what happens out there in the marketplace. There's an array of options outside of that. What I should quickly come back to is that you yourself focused on businesses with 35% off of Amazon. How is that going for you at the moment? Is that a full-on target that you don't move off of?
No, let me back it up. So we focus on 100% Amazon. We focus on 0% Amazon. So for us, it's really just a consumer product that's revenue concentration is e-commerce. Our criteria is more on the financial metrics because the way that we run our process, it's very difficult for us to run that process with someone that's got $400,000, $500,000, $600,000 of SDE versus someone who's got 1.5 to 2 million all the way up to 10 million of EBITDA. Our process works really, really, really well for those types of sellers. But no, we will. I mean, if I showed you our current deal roster right now, it is a mixed bag. Some have 90% Amazon, some have 100%, some have 0%. It's really truly a mixed bag. We're consumer products focused. So
cool.
Cool.
Well, this has been we've had a great conversation today. I think there's opened a lot of doors for people to think about. What is the best way that people can reach you?
Yeah, go to our website, globalwiredadvisors.com. Just type in Global Wired Advisors on Google. and for the 2% of you that are using Yahoo and Bing, just type it in. We'll come up number one. You can reach out directly to me. My email address is cs@globalwiredadvisors.com. We love talking about the space in this industry, and I know that there's some pretty good comments here that I haven't even looked at yet. So I'll definitely address those, and I may even just have them call me so we can have a longer discussion about it, just because, I think education is really important right now. There's a lot of fast data points that are happening, and you really, it's good to have conversations about what's happening to dispel a lot of misinformation, to dispel a lot of hearsay and rumor, and to really talk directly to what's actually happening, right? Yeah. So yeah, man, that's how we get in touch.
Cool. Guys, you're more than welcome. We'll get you back in the future, my friend. Guys, Sharon Evan will be back here tomorrow. Isabella, of course, will be here Monday. I'll be back here Tuesday and Wednesday next week. Take care of yourself and your family. Much love, and I'll see you soon.